Welcome to The Sound of Economics, the podcast by Bruegel, the Brussels-based economic think tank. I'm Giuseppe Porcaro, Head of Outreach and Governance here at Bruegel.
And I'm Guntram Wolff, I'm the Director of Bruegel.
And we are happy to welcome you in this second episode of The Sound of Economics Live. We are live streaming this recording, and usually we would have an audience in the studio to interact with us, but given the circumstances of the coronavirus pandemic, we are recording this remotely connected from our respective homes. For this live recording session, we are happy to connect with Bruegel Senior Fellow Nicolas Véron, who is joining us from Washington, D.C. Hi, Nicolas, how are you?
Very good, and so I say good morning because it's still morning in America.
Great, and we are here to discuss the fact that the shock of the coronavirus pandemic inevitably raises concerns about financial stability and credit availability. Can banks withstand it on their own, or will they require public intervention as in the recent financial and euro area crisis? Should regulations about loan loss provisioning and capital be amended beyond steps already taken by the European central banks and other authorities? How can the financial system contribute to economic loss? What are the specific prospects for the euro area with its present lack of fiscal union and unfinished banking union? Those are only few of the questions that we are going to tackle in this discussion, even if it may seem a rather technical discussion, and we're going through also some of the technicalities. As a non-expert myself, I may be asking some clarifications to both you and Guntram and Nicolas, and jump in the conversation to convey questions from the audience through Slido. But to start with the general question, are we again, Nicolas, in a systemic banking and financial crisis?
Not really. We are in a major crisis, that's obvious. It's a crisis of the real economy. There is a shock to the economy that comes from the spread of the virus and the measures that are taken to try to stop it. This is not coming from the financial system. The financial system is affected, but there is not really an indication yet, despite a lot of turmoil and liquidity stresses, there is not an indication yet that the financial system as a whole and the banking system within it have stopped to function in their mode for which they are designed, which is to allocate credit and capital in the economy. In other words, banks are still able to manage risks. They are still, by and large, solvent. We may come back to what that means in detail. The capital markets are very disturbed, and that's where most of the recent intervention has come on both sides of the Atlantic. But even in the capital markets, I would say it's a lot of volatility, it's a lot of turmoil, it's not complete. It's not an end to the value of those markets to signal, to transmit economic signal and to allocate capital. So a major economic shock, a shock that creates stress in the financial system, but not, unlike what we had in 2007, 2008, and later in the euro crisis, not a crisis that comes from dysfunction in the financial and banking sector.
Nicolas, perhaps before we talk about what comes next on the banking side, let's review a few minutes what has happened already in the last couple of weeks. I mean, we've seen the stock prices around the globe plummet. Also, the stock prices of banks have come down very tremendously. And there has been quite a bit of worry that banks would run out of US dollar liquidity in particular. And the swap lines that were agreed between the ECB and the Fed and other major central banks around the globe were immediately used. I think last week there was a major swap line auction. Can you just tell us a bit what is your reading of these violent market reactions, and in particular the shortage of US dollars?
So the traditional way of looking at it, which is not entirely inept, is to distinguish between liquidity and solvency concerns, right? Liquidity means that you can have access to money and credit if you need it, and if you are fulfill conditions, particularly of solvency. Solvency is when you can no longer meet your obligations because you just don't have the resources for that. And that involves a lot. Solvency assessment is judgmental. It involves a lot of evaluation decisions, measurement issues, accounting issues. By contrast, liquidity is something you see directly. Either you have the money or you don't have it. So there's a saying that liquidity, solvency is an opinion, but liquidity is a fact. We've seen tremendous stress in liquidity terms. And in foreign exchange, you mentioned dollar liquidity pressures. There are a lot of banks, but also other financial market participants around the world who need dollars because the dollar has a central role in the global financial system. And so to access dollars, they need, because when they are not directly in the US, they need to access it from their local financial system, and that's intermediated by the central bank. So the system that has been put in place is that central banks around the world, not only in the major economies like the Eurozone, Japan, the UK, but also in a number of major emerging markets, have those swap lines with the Federal Reserve, and the swap lines are a way for central banks to have access to dollar liquidity and then to transmit those dollars, this liquidity in dollars, to their local economic agents. So that has had to be mobilized in a bit of a rush, and it has been a bit bumpy. But I think the system works. The US, including at least so far Congress, accept that this is a legitimate role for the Federal Reserve to provide dollar liquidity across the world. And this is going to be controversial, let's face it. There will be hearings in Congress on whether the Federal Reserve is bailing out the rest of the world with dollars. Of course, it's not a bailout, but it will be depicted as such in US controversies, because that's always the case. But so far, it's accepted. And in other...
If I may interrupt on this point, I think so far it has been accepted, and there was, of course, a lot of worry that the US, under this current administration, would not want to play that role. And so I think markets and everybody was actually quite relieved that the Federal Reserve was ready to provide all of this liquidity, basically easing the pressure, the liquidity pressure on the banks. And I think we are all very happy that these liquidity worries have been largely resolved. So I think the debate is now really shifting quite a bit to what does this real economy shock mean for ultimately the solvency of the banks, and where the banks stand in terms of loss recognition. There's all kinds of suggestions that perhaps loss recognition should be made more obscure so as to allow banks to hide losses. But then, I mean, perhaps before we talk about this accounting side of it, let's talk a bit about sort of what it really means. I mean, we have a major shock, and this shock will lead to probably the biggest contraction in GDP, at least the steepest contraction in GDP since World War II. This obviously means that companies will have difficulties honoring their debt. It also means that we will see many other players, individuals, finding it difficult to honor their mortgages. Governments have stepped in and have provided support, credit support, also some solvency support, but still the shock is huge. And so what happens typically when you have such a shock is that some of the losses actually arrive in the banks. So is the valuation change that we are seeing in the stock market prices of banks, does this really reflect the expected losses? Can we see further drops in the valuation of stock prices of banks? And at what stage does this become a problem where we will need to start thinking about bailing out banks?
And Nicolas, before you answer to this from Guntram, still keeping on this very general issue that was laid down, I have a question from Slido, from Aline Orguan, who is asking, should the market shut down if the crisis gets worse? And she also refers to a world war One in this case, let's say at the start of World War I in Europe in 1914, shattered the exchange for 4 months. Is this scenario possible? It's kind of linked to the overall global question that Guntram was posing.
Okay, so lots of questions here. I think we all have in mind what happened with the great financial crisis in 2007-2008, and then with the Eurozone crisis. And we're trying to see the similarities and the differences, and there are some similarities. For example, we may come at some point to the discussion of what's happening in the Eurozone and the discussions about the fiscal framework of the Eurozone, the role of the ESM, the role of the ECB. There are similarities there in terms of the pressures on the resilience and sustainability of the Eurozone. But the fundamental thing is a difference. The difference is where the crisis comes from. In 2007, 2008, and also during the Eurozone crisis, with a few exceptions, Greece being an important one, the crisis was coming from the financial system. The financial system was fragile. It was full of vulnerabilities. The banks were undercapitalized. The banks didn't manage their risk well, and this created essentially the core fragilities that then was revealed by crisis. Here we're in a really different situation. The financial system, and particularly the banking system, is much more robust than it was in 2007, and this is because of all the reforms that were introduced after the crisis. So to put it in jargon, banks are much more strongly capitalized. They have buffers of capital, they have buffers of liquid assets, they have a number of precautionary preparatory measures that were designed exactly for this kind of event to make them withstand a major shock. The shock comes from outside of the financial system. It comes from, obviously, the virus and the reaction of governments. And this shock is huge. It will have massive economic consequences. And then these consequences, which are already unfolding, will unfold in all parts of the economy, including, of course, the financial system. But I think this sense of direction and the difference in the direction of travel of the crisis, if you will, is really fundamental to understand what's happening. So let me come to the questions that were asked. First, the one about shutting down the markets. And also we had on Slido a separate question about banning short selling. I think the current circumstances don't justify that. And the reason for that is that there is a lot of volatility in the market. There are indications of stress. We already discussed a bit liquidity in foreign exchange markets. There are other liquidity stresses than the one about dollar liquidity outside of the US. But by and large, the very swift and resolute action of central banks, which is not only about foreign exchange swaps, but a number of other programs and measures, has been able, in my view so far, to provide enough liquidity that we're not seeing a complete unraveling of market mechanisms and price formation and the way markets allow supply and demand to meet on a number of different securities and different financial instruments. So I don't think there is a reason at this point to close the markets because the markets are not, if you will, dysfunctional enough. Their price signal formation is not broken enough that it would be worthwhile to break the thermometer. Markets are a thermometer for the economy. It's good to have a thermometer. The thermometer is not perfect. We know that. But it's better to have one, even a flawed one, than none at all, as long as there is some signaling effect that reflects fundamentals in the price. Now, coming to Guntram's questions about the banks, I think you put it well, because a number of borrowers of the banks, to put it very simplistically, will have solvency issues. And this is going to be mitigated to a certain extent by fiscal measures and government action, for example, loan guarantees, for example, partial unemployment insurance. So some of the burden of paying employees will be transferred to the government, at least temporarily. For example, moratoriums on some expenses, for example, rents. But all of this will not be absolute, and there will still be businesses for which the loss of revenue from the crisis and the crisis, the pandemic fighting measures will be greater than whatever cost savings they can make, either by cutting costs or by benefiting from government assistance, or both. And therefore, there will be an impact to the banks because they will get more loans or assets that will not be reimbursed or not yield as initially expected, and that means losses. So how have regulators and supervisors responded to that? They have responded quite proactively. I'm going to limit myself for a moment just to the Eurozone, but similar measures have been taken elsewhere in the US, in the UK, in Switzerland, and elsewhere in the world. The ECB on March 12th, so already almost 2 weeks ago, has decided to provide the banks capital relief, by which I mean they have allowed banks to eat into their prudential buffers, which, as I mentioned before, have been built up since the last crisis. And that's a very powerful way to absorb losses. So the ECB estimates the capital relief as about 120 billion euro in core capital. That means that the Eurozone banking system collectively can take losses up to that amount, which is a very big amount in terms of losses to the banks when you take away all the other things that I've mentioned, such as, for example, government guarantees on loans, and they still meet their capital requirements. So I think this powerful measure, just the last sentence, is going to at least buy a lot of time. It doesn't address all the scenarios, and of course the critical parameter is how long does the lockdown last, and we know that's first order. But at this point, it should be enough to allow all the banks to keep meeting their capital requirements.
I mean, I think we have a lot of stuff here, and we should try to probably have shorter interventions to have a bit more interaction. But let me just try to zoom in a little bit on the last point that you just made, and perhaps also try to explain it for our general audience again. I mean, so I think you made a very clear statement. Banks are and will be incurring losses because of the shock in the real economy. And those losses, of course, mean losses that buy into first the profitability of the banks and later on even the capital base of the banks. Now, stock markets have already reacted very strongly to this. So the valuation of equity of banks has come down very significantly. And I think the big question now is, and you mentioned that, is how much buffers do banks have before they actually need to raise new equity? And you talked about these capital buffers, and if you can just explain a little bit more. What are the capital buffers they have? I mean, is this you mentioned 120 billion, if I understand correctly? Is this tier one capital? In other words, is it risk-weighted capital or is it actual equity? And can you just sort of explain a little bit to our listeners how this would in practice work and what the ECB really decided? So in the next question we can then discuss. Perhaps what it means in terms of the banking union, but let's first try to unpack a bit the mechanics here.
That's right, and you're right. All of this is not entirely simple, and one driver of complexity is that there are different measures of a bank's capital. There's a market measure, which is the market value of the bank's equity or stock. And as you mentioned, that decreased a lot as markets anticipated that losses would eat into that capital base, but also possibly force the banks to raise more capital that would dilute existing shareholders. That's a big driver of the loss of value of the bank stock price. And then there is a separate measure of capital, which is regulatory capital. So regulatory capital is something that is measured and watched by banking supervisors, so public authorities, like for the Eurozone, the European Central Bank, in its new capacity as a European banking supervisor, which it acquired in 2014 in the wake of the Eurozone crisis and decisions about banking union. And the capital requirements are set in different layers. So there is a core capital requirement, as you alluded to, which is called Core Equity Tier 1, CET1 in the jargon. And that has to be at least 4.5% of total risk-weighted assets. So the core equity tier 1, if you will, is the basic, most solid layer of capital, and banks really need to keep that in order to keep their license, basically. So a bank, to keep a license to have a banking activity, they need not only to be solvent in terms of the regulatory measurement of the balance sheet, but to have this capital base, which means their assets are better above their liabilities, so that they can face their obligations. And then on top of this core equity capital requirement, you have a number of additional requirements, which is typically, and I'm oversimplifying here, what we call buffers. For example, there is a capital conservation buffer, which was introduced in the Basel III reform, which was first sketched by the International Basel Committee on Banking Supervision in 2010. And that's an additional 2.5% of risk-weighted assets. I'm not entering now into the technicality of risk weighting, but that's a way to measure the total size of the balance sheet, risk-adjusted. And then you have other buffers. For example, in some countries, there were counter-cyclical buffers because times were good, so the banks were asked, if you will, to put a few more chestnuts aside. There are systemic risk buffers. There are a number of different buffers. And the same for liquidity requirements, which are something different from capital requirements. So what the ECB has done, and I'll stop there, is they said there are a number of those buffers, including some things that I haven't mentioned, again, it's very complicated, called Pillar 2 guidance, and the capital conservation buffer of 2.5% of risk-weighted assets. You can actually no longer have them. You can let your losses eat into those buffers, not into the core capital requirements, the basic layer, but on those extra buffers that have been built on top. And we won't blame you for that. There might be some conditions. You cannot distribute dividends or things like this, but you will still be considered by your supervisor as meeting your capital requirements, whatever the stock market are saying about it. It's not correlated directly to the stock price. And this, in the calculation of the ECB, freed up 120 billion of equity capital. That means that that's the amount of leeway that the ECB has given to the entire Eurozone banking system. Of course, it has to be divided at an individual bank basis, and the losses will be very heterogeneous, very different from one bank to another, but that's a lot of leeway.
Nicolas, let me understand a little bit better, because not being a technical person here, what you're saying basically, I mean, if I can recap and what I understand what you're saying, is that in practice, we have a liquidity problem. We are going to have a liquidity problem, but this should not be necessarily a problem for the financial markets, because the financial markets should have enough buffers inbuilt in the system to deal and cope with the shortage of liquidity. And that liquidity should be provided by the public authorities as with fiscal stimulus or other kind of measures that could come from central banks and stuff like that. Do I understand correctly?
You took a number of shortcuts from a technical standpoint.
Of course, I'm trying to make shortcuts for common people, or rather people that are interested in what is going on, but they don't are so much into the technicalities of the story. Because
but I would say there's a difference between the markets and the banks. So the financial system, if you will, it has a core which is linked to the transmission of monetary policy and the payment system, and that's the banks, because the banks are where the money is, as the saying has it, and they're the closest to the creation of money. So they have a special role to play in the system, because that's where, if you will, there is the highest element of trust, and that's embodied by a number of things, including deposit guarantees. And then beyond the banks, you have broader financial markets, including, securities markets, the stock market, bond markets, a number of other market segments, and connecting different jurisdictions, foreign exchange markets, we've mentioned that. And these typically are less highly regulated. You can have more losses than when you put the money in the bank, but you have more immediate risk measurement and price formation. than banks which are slower moving beasts. I mean, I'm super simplistic here.
Okay, yeah.
And I'm also taking a lot of shortcuts.
I was trying to get to the final point, which is, in the end of the day, with this crisis, there is going to be things that are not going to be paid somehow. There is going to be a problem in the real economy, which Guntram has been pointing out. If the banks are going to be functioning the same way that have been functioning according to the rules that have been set after the Euro crisis and the financial crisis of 2008, basically should in the banking system, this should be treated as business as usual. So my question is, are we on business as usual? Do we need a business as usual approach in the financial market, or are we, despite these buffers being there, despite the resilience of those systems, we are in a shock that requires some special regulations? And I think this is a question that is coming also from, I'm resuming and summing up different questions that are coming from the Slido as well on this.
And it's a very good way to put it, frankly. So basically, you're saying there's a loss to be absorbed. Who will take it? And what is the function of the financial system in that? So I think the answer of this is a number of financial market participants will take losses and already have taken losses. There will be losses to individual economic actors, people, businesses, and there is losses which is mutualized and socialized through governments. So fiscal losses, tax, basically fiscal expenditure through the national budgets. And the way these losses, and losses to the banks as well. Now, the banks are special, and banks, again, are just a subset of the financial system. The banks are special because they're directly part of the payment infrastructure. So they participate in the infrastructure of money in the economy, if you will. And that's what justifies a special protection, which means that they cannot fail or be allowed to fail exactly the same way as other participants in the economy, because we have to protect a social good, which is the trust in money, and the fact that when you have money, you can trust that you will not lose it out of nothing. So that's why we have deposit protection. We have special protection for banks. So the way the banks will participate in this gigantic loss making that we're talking about is just by being able to absorb more losses. And that's why, as I mentioned, and it's not the only mechanism, but regulators have allowed banks to have slightly lower capital requirements. That's the capital relief, the ability to eat into capital buffers so that they can take some losses, but not to the extent that they would become insolvent, because that would threaten trust in money. Now, what that also means is that the vast majority of losses that are going to be taken not directly by individual economic agents like people and companies will have to be socialized, not through the banking system, but through government budgets. So basically, fiscal action, fiscal stimulus is where our collective action has to focus. And that's fit and proper, because that's where society can think of mutualized expenses. There's an alternative view, which is you should have stimulus through the credit system, through the banking system. This is exactly what China has done in 2008. They have done a stimulus to the economy, not through fiscal expenditure, but through bank credit stimulation. Of course, it's a bit special because all their banks are majority owned by the state, and it's a very state-directed banking system, which is very different from what exists in Europe or the US. It's also not been ideal, frankly, because the fact that the stimulus was channeled through the banks has led to a lot of misallocation of credit, of corruption, of unnecessary losses in the systems that were frankly not efficient. I think most Chinese policymakers agree that it would have been better if they could have done that, if they had done it through the government budget. So it's a possible alternative, but it's not something that is advisable for countries like ours.
So let's talk a little bit about our speciality, which is sort of what it all means, all of this in the Eurozone and the European context. And I'm having, of course, already lots of debates on exactly this question of loss absorption and what it means for banking union. We've heard one measure where banking union has already proved beneficial, and Nicolas, you commented on that, which is the fact that the ECB, as the single supervisor, has given this additional leeway symmetrically to all banks in the entire Eurozone, and has therefore given certain loss absorption buffers to all the banks in the Eurozone. Now, I think the other big question that we are now discussing is what if losses are so big that actually capital shortfalls will be so big that banks will be basically having negative equity, meaning they will need to bail in not only the shareholders, but perhaps other creditors, and or receive public funding. Now, it is interesting in this debate that the European Commission has already generally agreed to make the state aid control framework laxer, so to allow governments more easily to pump into companies additional capital, additional equity, additional subsidies. This is a general measure, a support measure for the real economy. It's thought mostly for the real economy, but it does support companies in the real economy, and therefore hopefully will reduce the amount of losses that will end up in the balance sheet of banks. Now, in the case of the banks more specifically, we have, and Nicolas, we've discussed this many times, we have, in a sense, we have an unfinished framework. We have, on the one hand, a European level bank resolution framework where, if there is a public interest to resolve a bank as established by the systemic risk, the European systemic risk resolution
Single Resolution Board,
by the European Single Resolution Board, SRB. At that stage, we enter essentially into a European resolution framework where there's pretty tough bail-in rules, and those rules are quite difficult to circumvent. Now, the alternative to this is, of course, to put a bank into national insolvency, and that might look like a very attractive option at this stage. Given that the state aid control mechanisms have been that applied to the national state aid have been actually made easier. So I think we are having here quite an interesting moment, and the Single Resolution Board might find it actually quite difficult to say when there's a significant bank. To say that this is a European public interest where the Bank Resolution and Recovery Directive should apply. Where do you see these things, Nicolas?
Wow, lots to unpack again. So let me mention a few things in bullet point mode. There's a role for consolidation. Maybe some banks will acquire other banks, maybe under gentle suggestions from public authorities. We saw that particularly in the US in 2008. We may see a bit of that in the Eurozone, and that may even be a good thing. Now, of course, these are individual decisions by individual banks, and there might be suggestions from authorities and supervisors, but at the end of the day, the decision belongs to the banks themselves and their shareholders. There are a bunch of issues that we haven't even started to discuss about accounting and measurement. So on the accounting issues, Bruegel just published a blog yesterday night, which discusses some of the arcane points about loan loss provisioning and how that plays out in the US, in Europe, and where I defend the view that it's not the right moment to break the thermometer. We have a thermometer which is...
Let's discuss the accounting after this, because I think
exactly. So accounting issues, other issues that are not strictly about accounting standards, which are about measurement of non-performing loans or bad loans. So how should banks classify a loan as bad? This is a big point of contention right now. The ECB has introduced some flexibility, but not too much. I think they shouldn't go too far because, again, it's about not breaking the thermometer. I think our citizens, frankly, don't want authorities to give banks too much leeway to hide the bad news and then expect assistance from governments. We've seen a lot of popular backlash against bank bailouts in the previous cycle, and I think there are lessons to be learned there. There are other issues, for example.
Nicolas, on this point?
Just on this point very quickly, you saw that a former bank supervisor, Ignazio Angeloni, called for supervisory forbearance. I suppose you disagree with him.
Forbearance is an ambiguous word. It's used by different people in different ways. Ignazio is a former colleague at Bruegel, obviously. So I guess I won't directly answer that question. But basically, my point on this debate is that capital relief is justified under the circumstances. The very reason why we have buffers is for them to be used in circumstances like the current ones. But that's a very different thing from supervisory forbearance. Supervisory forbearance is coded language for supervisors allowing the banks to hide losses and not forcing them to recognize them and have the consequences in terms of regulatory requirements and possibly losing their banking license or being declared failing or likely to fail in the European legal jargon. This is not the time for supervisory forbearance because citizens are expecting transparency. They're not expecting special favors to banks. And I think there is a pledge here that is quite important. So we need capital relief, probably, but not supervisory forbearance. And what that means, and I'm coming back to your initial question, if a bank is no longer meeting its capital requirements, it's no longer able to meet its obligations, it should be declared failing or likely to fail. That's a responsibility for the supervisor. And if the supervisor doesn't do it, for the resolution authority. So in the Eurozone, that means ECB declares a bank failing or likely to fail. And if the ECB doesn't do it, and the SRB, the Single Resolution Board, which is this new agency that was created also as part of the banking union in 2015, if the ECB doesn't do what they have to do, the SRB can also declare a bank failing or likely to fail. Now, if a bank is failing or likely to fail, and we had a handful of examples in the last few years, then, as you mentioned, there's a complicated decision-making arborescence that may send the bank into either resolution under EU law or national insolvency. Sadly, and here I will be a bit more critical than you have been in your question, Guntram, this system doesn't work well. And that's a very sad statement to make now, but the framework of bank resolutions that was embodied in the Bank Recovery and Resolution Directive of 2014 is not working as intended, particularly in the Eurozone. So how that will play out in this crisis in the next few weeks, I have no idea. But one thing that I know for a fact is that this episode should provide a greater sense of urgency in making the system work, making resolution work as initially intended by our legislators, and making sure that indeed, at least in individual cases of bank failures, we have no need for taxpayer money. We have creditors bearing the losses. That's what the jargon calls a bail-in. And then in a systemic crisis, we can think about what exceptional measures may be needed. But it's a sad reflection that this system that was introduced in principle back in 2012, here we are in early 2020, it still doesn't work as intended. And now we're meeting another massive crisis without having the right preparation. So I think here, of course, now is not the time to discuss long-term structural reform, but there should be a memory of that so that when times go back to somewhat normal, as we hope they will get back at some point, new energy is put into this effort on which there have been a lot of discussions over the years, but no decisions of making resolution work and completing the banking union.
And Nicolas, there are a couple of questions on this. I mean, we are covering questions that are being asked on Slido, but there was a question about the European Banking Authority announcing today, 25th of March, and that looks like banks will have enormous flexibility on recognizing forbearance loans, reducing transparency. This is going a little bit in the direction, in an opposite direction of what you were just saying, I suppose, and how this resonates with what you're saying, and Also, maybe a couple of words about accounting standards, because there is also this other debate about the accounting standards and should they be relaxed or shouldn't they be relaxed, and they are kind of connected.
I'm aware of the statement of the European Banking Authority, but I haven't read it yet. It's a morning in the US, as I said, and things are moving too fast for me. So I'm not going to comment on that statement, but I'm going to comment on the accounting standards indeed. There's no way to have a perfect standard, a perfect thermometer for loan losses. There are two different concepts: incurred losses, which we had before the great financial crisis, and expected loss provisioning that was introduced in the wake of the great financial crisis, with standards that were issued, I think, in 2013 by the International Accounting Standards Board, and in 2016 for the US equivalent, because the US is still have their own accounting system. So now we have a system which is called expected loss provisioning. Again, none of these systems is perfect. They both create what economists call procyclicality in different circumstances. So there is a risk that they may exacerbate market perceptions when losses either start becoming forecast in expected loss provisioning or start actually happening in incurred loss provisioning. My point here is very simple. We have made a collective choice, in this case for expected loss provisioning, as a result of the last crisis. Is that an ideal method? No, it isn't, and no method is ideal. But now is not the time to break the thermometer, to change the standards in a hurry. So it is important. I'm not making a forecast here. I don't know what will happen, but I think it's important that the tremendous political pressures and the bank lobbying is relentless. The pressures to break the thermometer, to change the accounting standards in a rush are enormous. They should be resisted. Why? Because it's a matter of public trust. We have seen that bank lobbying is generally misguided when it comes to accounting measurement and capital. Banks have spent a decade lobbying against Basel III. Now, thanks God, we have Basel III. Basel III is exactly the reason why we can provide this capital relief that is so important given the circumstances. So Basel III was exactly the right thing to do. We know it now from absolutely critical experience. The same applies to accounting standards. After the crisis, it will be time to revisit this and have an honest debate on whether, at the end of the day, maybe it's better to go back to incurred loss provisioning. But now is not the time to do this. And now we should just apply the standards we have as honestly as possible, as transparently as possible, not listening to lobbying from banks, because they have been proven in recent times not to be given advice in the public interest.
So Nicolas, I mean, let's get a few questions from the audience, because we are actually already having 39 questions on Slido. So let me just read one question, and you discussed it already shortly, but I think it deserves a bit more elaboration, by Jack Schickler from Amlex. He's saying EU banks were already weak and in need of consolidation before the crisis. At what point should regulators again allow mergers and resolutions to happen? So can you say a few words? Are we about to see a big consolidation wave of banks in Europe? And isn't the incomplete banking union framework that we also discussed actually an obstacle to this now?
Absolutely, Guntram, you're right. And I think there are two levels here. One is the legislative level, and the discussion on completing the banking union. And as I mentioned, there's been a lot of debate about this in a number of groups of the ECOFIN Council and subgroups. And there has been progress, but no decision, particularly in the last 12 months. So I think this, what's happening now, should inject a sense of urgency into that decision. It's not the most urgent discussion because it's a legislative thing. It will take time. There are more urgent issues in terms of fighting the pandemic itself, but as soon as we go back to a kind of normal mode, there should be new energy in the discussion about completing the banking union, which can be done without treaty change, without fiscal union, without anything particularly radical, but it's politically difficult. So there should be focus on this, and I expect that the Commission, Commissioner, Vice President Dombrovskis, and others will put a lot of their focus into this in the rest of the year, not the immediate next days or next weeks, but in 2020. Now, there is something more immediate, which is what's going to happen to the system in terms of structure. And you mentioned cross-border consolidation, you mentioned resolution, banks either being purchased by others or by equity investors, for example, private equity, or being closed down through a resolution or liquidation process. And here, I think indeed the Eurozone banking crisis sector is still fragile. As I mentioned, it's properly capitalized, which is important and wasn't the case 10 years ago, but it's not profitable enough. There are too many banks, and this is a sector that is crying for restructuring and rationalization and consolidation. So I agree with that. And probably things will happen in the months ahead. I don't know exactly what, but it's likely that this crisis will create an acceleration effect here. Now, when it comes to resolution, I think it's important that we get back on track to what was intended by legislators when they drafted and voted BRRD, the Bank Recovery and Resolution Directive, and that we get the resolution system to function as much as possible as was initially intended. And that's very difficult in a crisis, but I think it's also important. So if you want a parallel, there was an episode of that nature in early October 2008, with this big battle between the US Treasury and the Federal Deposit Insurance Corporation on a bank called Washington Mutual. It was actually a thrift, but basically like a bank. Big institution, $300 billion balance sheet. And the FDIC was saying it has to be closed according to the rule book with losses to the creditors, and the Treasury was wary of that. The FDIC won that day. Creditors had to incur losses. It was the right decision to make. So we need something like that, and I think this puts a high onus of responsibility on the Single Resolution Board, because that means that maybe the Single Resolution Board will have to revise their recent practice and accept that banks are public interest institutions even when they're not super big. Sorry if that's a bit of jargon. And really think in terms of how we can have a sustainable mechanism that makes resolution work as our legislators wanted it to work when they voted the current legislative framework.
So we have to come to three very quick last questions, and please let's try to give very short answers to those. But I think it's important to actually take those three questions. So the first one is by Mr. Anonymous, unfortunately, but it's still an interesting question. There is a mounting debate about the fact that banks should stop share buybacks and do not distribute dividends on 2020 results. So is it time to for the supervisors to tighten the screws on shareholders and on bank management?
Yes, but it's even better if the banking sector comes to that conclusion itself. And there are current discussions, for example, within the European Banking Federation, according to the media, that are ongoing as we speak about exactly this. So in Sweden, for example, supervisors have said, no more buybacks, no more dividends for the time being. In the Eurozone, we're not yet there, but I think it would be absolutely appropriate for banks to take leadership here collectively, say we're withholding dividends, we're actually cutting bonuses for executives. That would be the right thing to do, also in terms of their image in broader society. And certainly stopping dividends and absolutely stopping buybacks. This is not the time to give the money back to shareholders. It's the time to keep the money to build up capital and be able to absorb losses, because there will be losses.
So a second question by Jeroen Peers from the Treasury of Belgium is, what role do you believe public guarantee schemes on short-term loans from banks to firms in trouble could play in guarding confidence in markets and in banks?
Yeah, there are a lot of public guarantee schemes that have been announced in different member states and also outside Europe in recent days and weeks. And I think this is absolutely appropriate given the nature of the shock. So these public guarantee systems, loan guarantee systems, should be recognized as much as appropriate by supervisors. So when a loan is guaranteed and misses a payment, that should not necessarily become a non-performing loan. There are a lot of technical and difficult questions here, so I'm not entering into the details. But I think this exactly echoes what I was saying before in response to Giuseppe. A lot of the burden has to be taken by governments, by the budget, by fiscal action. Loan guarantees are of that nature, and they should be allowed to work also in terms of measurement of losses in the bank accounting and regulatory system.
So then I see two questions actually, and I think I will take those two on the inflation effects of current monetary stimulus. So two people worry. One person here says, do you fear that rising inflation rates will rise because production output is going down and money is funneled into the system through central banks? I think my take about this question at this stage, but it's of course a big debate, is that we are currently seeing both a supply effect, but we see an even bigger demand effect. In other words, I don't see inflation really increasing at this stage. On the contrary, I would rather expect inflation to probably go down because of the second round demand effects that are so much stronger than the supply effects. And in principle, I don't think if we can reopen the economy relatively quickly, I think we will relatively quickly be able to resume production, while demand will probably for quite some time lag behind, because basically households and companies will want to make up for the losses that they have incurred. Perhaps let me, Nicolas, ask you from my side, from one last question here from the audience, and I don't know if Giuseppe has one after that, but a person called Frédéric asked a question that I think you will enjoy. Is the close link between banks and governments, which caused the turmoil in 2010-11, sufficiently addressed to avoid a repeat this time, or is it not?
The answer is it's not. We know that the bank sovereign vicious circle has not been broken despite the pledges at the highest level of political leadership repeated several times by our heads of state and government. And this is exactly what I was referring to before in our conversation when saying it's time to put new energy into debate about completing the banking union. Completing the banking union and breaking the bank sovereign vicious circle, from my perspective, are exact synonyms. They mean the exact same thing. And that's logical because the banking union has been defined by our leaders when they started it in 2012 as an imperative to break the vicious circle between banks and sovereigns. I quote repeated declarations. So that's politically very difficult, but it's not impossible. As I said, it doesn't require fiscal union or no further steps towards fiscal union. It doesn't require treaty change, but it requires things like limiting the concentrated exposures to sovereigns on banks' balance sheets. It requires things like European deposit insurance. And critically, it requires what I mentioned before, which is making the resolution system work. At least when there are isolated cases of banks failing, they shouldn't need to require taxpayer money. And all this is very complicated. It's a difficult discussion. It's not the most urgent thing, but it should be put as a very high level of priority by the Commission, by Mrs. von der Leyen, by Mr. Dombrovskis, by the different authorities and institutions as soon as they can get back to legislative work.
Well, I mean, let me just say on this question, how much fiscal union we need to complete banking union. We have lots of debates and also lots of disagreements within Bruegel. And I guess you and I, we also have some different views. But I think it would take us too far away from in this podcast to discuss that. So I think
yes,
Giuseppe,
indeed, I was about to say that as a last link, it's exactly this, that we come back to the square of the circle, that there is an extreme link of this discussion to the discussion about the fiscal policies and what to do in this very moment at the European level, which is something that is an ongoing debate. And that we at Bruegel are taking over on many different occasions now in those days of coronavirus emergencies, in different blogs and other events and further podcasts live that we're going to do in the coming days on this topic. So I just wanted to say that this is not a closed conversation and that we cannot exhaust all the questions in this amount of time, but I wanted to thank Nicolas for having joined us from the other side of the Atlantic. So thanks for our listeners and all the participants that joined remotely and actively asked questions. You may find specifically a blog post by Nicolas on the very same issue that we debated today in this episode of the Sounds of Economics Live on our website www.bruegel.org, alongside other podcasts and publications. So thank you very much. Stay tuned with the Sound of Economics. Until next time, bye bye.